Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, and welcome. This is the Investor Coaching Show, and I am Paul Winkler. He is Evan Barner, hanging out with me here in the studio today on this lovely Saturday. And we finally got rain, for Christ's sakes.
And we finally got sun, actually.
And we do. I'm looking out there. Look at that.
It's like, whoa, where'd that come from?
How do you like that? Yeah, this is good. We're living right, I think. Or something like that. We got rain and we got sun. I can't get better. All right.
Climate change.
No. You know, it's
rain and sun, climate change.
I have been off on a tear on something. I probably shouldn't talk about it. Watching a lot of educational videos on just some things that are just fascinating. And the thing that I've been watching videos on is recycling. That is fascinating. Where you just yeah.
We both need a social life, man.
We really do. We probably do. Okay, I will admit.
I'm watching Clarkson's Farm and you're watching recycling videos.
Oh, wow. I'm not going to get into that. It's not investing related. It's like, it's like getting into politics. It just does nothing but get you in trouble, especially when it comes to investing. Because, when it comes to investing, politics, and, people think, and I had this happen, a few times where people, in government, I've had some meetings with people in government offices and things like that where they're asking about their program, the TSP. And a lot of people apparently thought when Trump came in that it was going to be U.S. markets were just going to take off. And they were just not so pleasantly surprised when they put most of their money in the C fund at the TSP that it has been the big lagger. Compared to the iFund anyway. So people think that all of a sudden, hey, it's going to be politically better for U.S. companies. This is going to be the opportunity. This is going to be great. No, not necessarily. That's not how markets work. But anyway, what happened was this morning, I still don't have a life. I mean, I still do this. I got on and I was on YouTube. Uh-huh. And I decided that I was just going to pull up some videos on, actually what I was looking for one type of video, but it said, here, you might be interested in this. And they were actually scary. It was scary how accurate they were on what I'd be interested in.
Yes.
It blew my mind. It had all of these topics that are just little areas that I just love studying that came up on the YouTube videos. So I was like, wow, this is amazing. But in a way, it's cool. In a way, it's scary. But for me, the cool factor outweighs it because I like, being shown things that I might find of interest. Well, one of the things that they said I would find of interest, but I found it of interest only for reasons that are just to point out how bad the investing advice is out there. It was an investing advice type of a thing. A young guy, I'm going to say young guy compared to me, I would say early 40s, probably somewhere in that neighborhood. Yeah. This guy that was teaching this video. And I'm going to play this video for you because I want you to hear what he's talking about. It's almost like it's an ad for Fidelity, but it's not. It doesn't seem to be that he works for them. But he talks about 4 Fidelity funds that he wants to introduce you to that he thinks that you ought to be paying attention to.
If you're serious about building wealth, there's one thing you need to get right: picking the correct tools to make it all happen. And when it comes to investing, Fidelity has some of the best options out there. But since they offer over 9,000 funds to choose from...
Now, number one, right off the bat, Evan's laughing, which is,
Wow.
9,000 funds. He's going to say there are just 4 that you need, but they have 9,000.
Down from 13,000.
Well, you're looking at different share classes to get it up to 13,000, right? But, the idea being that if you have a company like this managing your money, they've got that number of funds. What is the likelihood they're not going to stray off and put you into something else just because they want to feed money to that fund or something like that? What are the odds that that'll happen? It could be very, very high. Anyway, I'll continue.
How do you know which ones will actually grow your net worth without having to pay excessive fees that will slowly drain your investment?
Now, that's one of the things that they focus on. That's it. What are the fees? And the reality of it is there are funds that will have higher fees amongst those choices that would be much, much better diversifiers than the one this guy is going to point out. So let me continue.
In this video, I'm breaking down the top 4 Fidelity index funds that can help you fast track your path to financial freedom by exploding your net worth.
Oh, that sounds good. We're going to explode my net worth. That sounds real, fantastic.
It sounds like the .com bubble.
Exploding your net worth. That's true. So when things explode, it could be bad, right? It's like demolition of your investment portfolio.
Read the room. Yeah.
So the first fund that he picks is right here.
First up is the Fidelity 500 Index Fund, FXAIX. It's a low-cost index fund that's designed to track the performance of the S&P 500 index. This means it holds shares of 500 of the largest publicly traded companies in the United States, providing exposure to a broad range of industries like technology, healthcare, financial services, and a lot more. FXAIX is often referred to as a core holding in many portfolios because of its reliable long-term growth potential. It gives investors instant diversification within the largest stocks, which historically have been a consistent driver of stock market returns.
Now that sounds great. You're diversified amongst a lot of different sectors, a lot of different areas of the market, and that sounds really good. The problem that you run into is that most of your money is in just a few companies. Now, to his credit, he does point that out later on, but literally NVIDIA is almost 8%. When you put money in that fund with 500 companies of it, almost 10%, just shy of 10% of your money is in one stock. And almost, just shy of 7% is in the next stock. And just over 6% is in the next stock. So literally you're sitting on almost 20% of your money in 3 to 4 companies. 20% of your money out of a 500 stock index. So you feel like you're diversified, but the question is, are you really diversified when you do that? Because when you look back through history, you go back in the 1960s through the early 1980s, you go from 2000 through like 2012, you can have long periods of time with zero returns. Now, he gives an analysis, Evan, on this of the S&P 500. So check this analysis of the S&P 500 because there's a lot of stuff for us to talk about right here.
Because FXAIX mirrors the S&P 500, it may become heavily weighted towards certain sectors like technology, which currently makes up a significant portion of the index. If tech experiences a downturn for whatever reason, it could overly affect this fund. While this fund does pay dividends, they're generally lower than those from funds focusing on higher dividend stocks. So this one is currently sitting at 1.42%. For investors like me, we don't really care about dividends during the accumulation phase of investing. So
what's wrong with that? What's wrong with that right there? During the accumulation phase, we don't care about dividends. Now, if you don't know anything about investing or know very little about investing, dividends are a subset of the earnings of the company. So when a company pays the dividends, they have earnings. You break it up into retained earnings, and then you also have dividends that are paid out. Now, if we look at companies that pay more in dividends, so he's talking about, talking about here, if I have a company that has been paying dividends and it's a high percentage of the value of the fund.
Right.
Now, what you have is a value company. If those percentages are high, that's a value company. In 96% of 20-year periods, value has had a higher return than growth. So are we basically saying that we don't want to have value?
We don't want any more of those better performing companies, Paul.
Yeah. That to me is insane. You know, and as a younger investor. And then what does he talk about? You know, when do I want that? When I am retired. Which is, what are value companies? They're distressed companies. I want more of that when I am older and I am more vulnerable to market downturns and to those dividends going away. And I'm going to rely on that for income. I mean, he's basically had two myths in one. I mean,
well, you know, your income book talks about, you know, on the retired side of that arc is, you know, the dividend strategy has all kinds of issues with it. Mm-hmm. And it is interesting that he is discounting it on both ends of the spectrum for the wrong reasons.
Right, exactly. It's just bad information. So I'll continue.
This isn't a big deal, but I know some people prefer to focus a lot on dividend returns, so this one might not be for that person.
Okay. So this might not be for that person. No, that is just bad analysis. So number one, you know, he goes that direction. Then what he does is he decides that he's going to move to another fund, and he's going to recommend the total stock market fund. This would be a more diversified portfolio in his assumption right here. So this is what he says next.
Next up is the Fidelity Total Market Index Fund, FSKAX. It's a low-cost index fund that aims to replicate the performance of the entire U.S. stock market, which is why it holds about 3,000 stocks. Unlike the S&P 500 index fund we just talked about, which focuses solely on large-cap companies, the Total Market Index Fund includes thousands of stocks across all market sizes, from large-cap, mid-cap, and small-cap. This makes it one of the most diversified funds available because it provides exposure to a broad range of industries and companies. With how diversified this fund is, it allows you to benefit from the growth of both established companies and smaller, high-growth potential companies. It's a great one-and-done fund for all investors.
Yeah, this sounds great, doesn't it? I mean, really diversified across all these different sectors. You know, instead of just owning 500 companies, you own, 3,000-4,000 different companies in your portfolio, and you are diversified. Now, what is diversification? How do we measure diversification? We look at correlations. So if I have two things that move together, bathing suits, this way Evan and I describe it in the very first workshop that we teach. If I have two investments, let's say bathing suit sales drives one of them and suntan oil sales drives the other one. So maybe it's a bathing suit company and a suntan oil company. And we look at that and we say, okay, they're basically going to move together. They're going to be highly correlated because they're going to sell more in the summer than they are in the winter, right? You know, so if we look at that, the correlation of these two things, it's like the old joke that says if two people have the same opinion on everything, one of them isn't needed. Okay, so if we look at diversification and say, what is it? Diversification is, by definition, things that don't move with each other. When one zigs, the other one zags. Now, if we look at that, how do we measure that? We use correlation coefficients. So if I have a positive 1 correlation, that means that they always move together. If I have a negative 1 correlation, that means they always move apart. Do you know what the correlation coefficient is of the S&P 500 versus the total market? You want to guess what that is, Evan?
I'm going to go with like 0.99.
Oh my gosh, you're good. You are good. That is exactly right. It's 0.991.
Gosh.
Yeah, you don't get any closer than that, buddy.
Yeah.
You do not get any closer than that. Good job.
Well, and while you're going through that, I was pulling up that fund.
Yeah.
And so it has 30% of that fund, the total market, which is in the top 8 stocks, and all but one are the same top 8 stocks in the S&P 500 fund that he just recommended.
There you go.
They're the same exact holdings and percentages.
Yeah, there you go. I mean, it's just the same exact junk all over again. So you look at that and go, well, wait a minute. Do we really get diversification? Is it really everything? And he's like, hey, you got small companies, you got large companies, and it's wrong. I mean, this is just the level of bad information there is out there on the internet. And I want to continue. He's got another fund that he's recommending here. You ready for this? Here's the next one. Okay. You can probably guess what it is.
Is the Fidelity Total International Index Fund, FTIHX. It's a low-cost index fund designed to track the performance of the global stock market outside of the United States. It invests in a mix of developed and emerging market stocks, giving you exposure to over 5,000 companies from regions like Europe, Asia, Latin America, and many more. International markets often perform differently from U.S. markets. By including this fund in your portfolio, you can reduce your reliance on the U.S. economy and tap into growth opportunities across the globe. It's an important building block for achieving global diversification.
Now, that sounds good. Hey, at least we're getting something outside the United States, not just U.S. companies, but international companies. Here's the problem. When we're looking at the companies in that portfolio, the biggest holdings are going to be companies that will be competing against big U.S. companies. So we're really dealing with something that doesn't diversify us as well because they move a lot with each other. When we look at Nissan, they are competing against Ford. And when we look at Nestle, they're competing against Hershey. So we have another problem here in that we're not getting that level of diversification. But he says, hey, it owns the whole market. It gets in emerging markets, getting these small companies and so on and so forth. One of the things that they dealt with in all of this is not enough value exposure. When you look at that and go, well, why do we want to value exposure? Because it has dissimilar price movement historically. 96% of 20-year periods, value has a higher return than growth does. And it can really help with diversification and increased expected return over longer periods of time, but also in retirement. When I'm physically in retirement, when we look at big downturns historically in the markets, we've actually seen that because those companies already have low prices compared to their book values and their assets and their earnings and those types of things, that they don't tend to go down as much during down markets. So it's a diversifier for that reason as well. So what's the difference? Well, if you look at, for example, the total international stock market portfolio that he's talking about, what's the rate of return to yesterday, September 5th? About 22%. You go, hey, that's not bad. It's better than, a poke in the eye with a sharp stick. It's better than the S&P 500 for sure, right? You got 11% return for the total international, or total U.S., excuse me. So it's double the return. I mean, clearly, the whole idea, as I started this whole segment with, that it was going to be U.S. stocks all the way this year, according to a lot of people that I talked to that work for the state, for government offices and have the TSP plan, Thrift Savings Plan, who were betting on U.S. markets being the best thing going forward. It is clearly international, even international large, that has done better. But you look at small international value companies, which would be a very different area that wouldn't be well represented here, and that's up 37%. To the same period of time. So you look at it and go, well, 22%, well, 37% seems like a little bit better. It is. And when we're dealing with the correlation coefficients, when we're dealing with diversification and how you measure diversification, you will find that the correlation coefficient is a lot lower when it comes to these asset categories. It's not negative. We don't get negative with stock markets. But it's a lot lower. You're dealing with in the neighborhood of like 50.5 is what you're looking for in that particular area, which is, you're looking at a lot of the time they don't move together. Sometimes they move together, but it's to very dissimilar amounts. You might have a market recovery where, like, for example, after 2008, you had the 2009, or go back to 2003, when you had high 20% returns for the S&P 500, but you had 70% returns for other areas of the market. There are other market segments that went up that much. And when we're going through market fluctuations, when markets went down in 2000, you had value, the S&P 500 anyway, went down in 2000, you had value stocks went up 10%. So you can have opposite movement. It can happen. That's why the correlations are much, much lower, because there are some asset categories that do move the opposite direction altogether. In 2001, you had a 12% decline in the S&P 500, but you had like a 30% return in the smaller companies, smaller U.S. companies and value in particular. And then in 2002, when 22% decline in the S&P 500, and you had international companies go up 5%. So, you look at these types of things, you go, okay, so that's what really constitutes diversification. But often what people think of as diversification, as this guy was talking about right there, is just owning a lot of different things, owning a lot of stocks, owning 4,000, right? Now, his fourth, can you guess, Evan, what the fourth pick of all of his stuff was?
I'm going to go with total bond of some kind, unless it's
that's where I thought he was going to go
a small
too.
cap index of some kind.
No, that's funny you say that. That's where I thought he was going to go too. It's not where he went. He went with the Freedom Funds, which is a combination. Yeah, exactly. Which is a combination of the Freedom Index Funds, which is a combination of the total U.S. market, total international market, and some bonds, a varying amount of bonds based on time horizon of the investor. And that was where he went with that. And I thought, wow, just not good advice out there on the internet. Sorry. Bad grade on that report card.
Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. Hey, what's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax.
So Evan, what do you think about all that? I'm throwing you on the spot here. I'm just thinking about all the debate about, interest rates and, short-term interest rates. We kind of talked a little bit about that before, but you get a lot of people asking about that, the pressure on interest rates, what would happen, if you have short-term interest rates, CD rates, and how that's all mixed in, and you have people asking about that.
I think most of the time when I get a question around interest rates is it's always prefaced by, hey, well, I know you guys don't make predictions.
I knew that was coming.
What do you think is going to happen with the rates? Like, I don't know. And then proceed to, talk. And the other time it comes up is, hey, I've got some cash. I'm getting nothing at the bank. What are some money markets, or, what are you seeing, CD rates if I'm not going to need the cash, that kind of thing. Shopping around. But
high yield savings accounts, those types of things you end up talking about. I do talk about. They do have a lot of people that are okay with the online banks.
I do, which actually surprises me.
Yeah, it surprised me too.
But I think COVID, for better or for worse, people were willing to accept technology as a substitute for human connection.
Right.
I think that if the website goes down over the weekend and you can't see how much money you have, I think people may change their views on some of those things.
Right.
Kind of like not being able to check your email for a weekend. But I think people, what it does, though, is it opens the opportunity for the conversation of you don't really need to be a Fed watcher because, as you'd mentioned earlier, they only control the Fed funds rate. And, excuse me, there was an interesting article, actually, I think, out of Morningstar that was talking about 7 reasons to stop fretting about the Fed. And, they were talking about bond prices and all this volatility, but in recent years, we haven't seen some of the same volatility that you would normally see for from rate hikes, or at least thoughts about rate hikes, and that the interest rate shifting creates problems, more dramatically in longer term bonds. And so we have that conversation of why we're not using long-term bonds in the portfolio.
Yeah, that's a really good point, because in a lot of 401k plans, we see longer bonds, and we have to steer people away from them.
Yeah, and
because the interest rates are higher, they're attractive to people. They think higher interest rates, oh, that's good, that's what I want, don't I? No, you've got to watch how it moves with other things, but yeah.
And then just kind of thinking about interest rates and bonds in general, there was another article, I think this one was from Bloomberg, and junk bond rates are approaching government rates.
Yes,
there's a lot of rate compression going on.
That is exactly right.
But if we have if companies, because the government doesn't issue junk bonds, right? So that's by definition is going to be a corporate or I guess municipal.
Well, corporations, and municipals. Corporations with one foot on a banana peel and the other in bankruptcy court, or municipalities that are in financial trouble.
And so if somebody's got this big bond issue and then a tariff comes in and wipes out their quarterly earnings, all of a sudden your junk bond that had a spread of 0.5, you may all of a sudden be underwater. So I just use it really as a reminder to re-educate clients on here's why we have these fixed income instruments in there. It's not just, monkeys throwing darts at a board. Yeah. There's a lot of purpose behind the fixed income side, just like there is on the equity side.
And it really ought to give you some pause when you see those high yield bonds giving returns or interest rate payments that are nearing government bonds, because it tells you that people are so hungry for yield that they're willing to bid up the price of the junk bond, and that those two things go opposite each other. If you have higher prices, you have lower yields, and that's basically what's been happening. And I talked about that a couple weeks ago because this is kind of crazy. This is nuts. This is some things you really, really want to watch out for, because a lot of people don't recognize that they're taking risks until it's too late, until that area comes crashing down. Like the 2008, you had some of those junk bond funds dropping 40%.
Yeah, or what was it?
78% for the
Oppenheimer,
for the one. You have the Oppenheimer
something.
Champ Fund. Yeah, the Champ. That we called it the Chump Fund.
Yeah, gosh.
It was unfortunate. A lot of people had their kids' college education in that fund, and they, juniors getting ready to go to school. We got in the Champ Fund. Oops, in a 529, and then all of a sudden they came crashing down. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.